started climbing on my leg. So he wanted to say hi to you. If you don't know who this is Sunny, one of my two Shih Tzus that spend the morning with me in my office. There you go, buddy. Folks, it is Tuesday, September 20th, and I hope you have an amazing day. Let's talk about what is going on in the financial markets. Let's start at the bottom. Usually I start at the top. Let's start at the bottom. First, we have to talk about OPENDOOR. OPENDOOR is feeling the pain. OPENDOOR, as of their last report, 42% of their transactions are being sold at a loss. I want to rewind the clock about 1 month. 1 month ago, I brought you two examples of people following this channel who told you how to buy great deals on OPENDOOR. This is what we learned from both of them. 1, write multiple offers. 2, follow up. And 3, and this is important, about day 90, OPENDOOR wants it off their books. It appears that that cycle is actually accelerating. OPENDOOR is in trouble. OPENDOOR has no emotional connection to these houses. Go get a deal. Don't overpay. Get aggressive. I believe in both of our examples, both buyers got the property for more than 20% off their original price. Both buyers got OPENDOOR to pay closing cost and rate buy down. Folks, buying property today at list price as an investor makes no sense. Stop shopping in first day listings. Just stop. Wait for days on market. For me, I am not looking at anything less than 30 days. If OPENDOOR was in my market in detail, I would probably be writing offers on every OPENDOOR listing over 60 days. For me, it's a game of numbers. Write the offer at a stupid low number. See how they react. They probably tell you to F off. Follow up in a week. Follow up in 2 weeks. Increase your number a little bit. Only do great deals. Frankly, if OPENDOOR accepts your first offer, you paid too much. I want you to hear me now. If OPENDOOR accepts your first offer, you likely paid too much. Folks, this game is about cash flow. Cash flow. Go get it. Yield, 30-year debt, get rate buy down. Use this time. Here's the second thing about OPENDOOR. OPENDOOR has a set of properties. Once that set of property is gone, they're gone. I would hope they're buying different. I would hope, frankly, they stop buying because they're horrible at buying. They could also say, hey, let's take 500 Phoenix doors and sell it to private equity. Sell it to someone else. So OPENDOOR is just, it's a bad business. iBuyers is a bad business because their compensation model was broken. When you have a business that has 3 phases, buying, repairing, selling, and you have 3 individual teams, I only want to be on the team that's buying. Because once you're on the team that's buying, you have an open checkbook. You can overpay. And then you could blame the repair team, and you could blame the sales team, and you could blame the market. No, you idiots at OPENDOOR. If you're flipping homes or investing in homes, your money is made or lost when you buy. Your buying team, OPENDOOR, sucks. Take that. Your buying team sucks. Next up, new listings. Man, about 5 or 6 weeks ago, I made a bold call that I thought listings were going to start dropping. In hindsight, it is one of my more accurate calls. I was out on a limb when I made this because inventory was shooting up like that. Looks like new listings are down 23%. We are going to see days on market expand. But more importantly, as we head to the end of the year, I do believe we are going to have less inventory, probably significantly less inventory in December than we do today. And that is just going to keep this depression in the housing market going. We are going to get to 50% crash in transactions, probably February, March of next year. It's going to be interesting. It's going to be interesting. Next up, the 10-year note. The 10-year note is been bouncing on off of 350, right? 3.5. It got there, pushed down. Well, this morning, folks, it not only got through it, it blew it away. Last time I checked, which hasn't been for an hour or so, it is now at 3.58. That 350 level is no longer a ceiling. It is now support. We are going higher. Mortgage rates are going higher. You thought the housing market was broken at 6? Wait till the housing market's at 6.5, 6.75, 7. We are not only going to have record demand destruction, which is very easy to see. We are now going to experience supply destruction. A lot of these YouTube channels talking about real estate crashing don't understand just how epic, once in a 40 or 50 year time frame, just never seen before if you're not looking for it, crash in supply. We got to get the next 6 months. I don't know what to tell you. Horrible demand, horrible supply. We got to get to March and see who blinks first. Right now, buyers and sellers, they're living in two different worlds. It's like Back to the Future. Sellers are living in the past. Buyers are living in the future. Yeah, it's pretty tough out there. Mark Zandi with the one of the more obvious calls in the market. Mark Zandi, someone I fully respect. I think he's amazing. Any economist worth their salt makes calls. They're wrong, as am I all the time. But this one, Mark, I think you got a safe bet. Mark Zandi tells us layoffs are going to increase. Now, of course they are. If you've been on this channel for a while, you and I know this. More importantly, we are not trying to scare you. We are trying to prepare you. Folks, again, make sure you have 6 months of reserves. Make sure you get close to revenue. Just all of these things. And again, as we'll see in a minute, unemployment rate is looking to go higher, but not very high, at least historically speaking. We'll talk about that in a minute. But yes, Mark, I think you are right, Mark. Layoffs will increase as we get to the end of the year, and probably more in Q1. But yeah, I think layoffs are going to go up. Wall Street expectations. This is important. If you've been watching my channel for 90 days, you know I've had this battle. I have one Wall Street veteran and one stock trader every week, just to balance out my content. And I have been confused. As a macroeconomist, I'm like, dude, Fed's going higher. What the hell? What do you think? Wall Street, Cathie Wood, Elon Musk. The list gets long. No, the Fed's going to stop. The Fed's going to pivot. The Fed's going to cut. I'm like, I don't know what's going on. But yes, that has been the talk track. It looks like Wall Street expectations are starting to change. Here we go. Wall Street expects the funds rate to be at 3.9 by the end of the year. Let's call it 4. Wall Street expects the peak, or what is often called the terminal rate, to be at 4.26 by March of 2023. Wall Street expects the Fed to overdo it, mean go too far. That is obviously very much a Wall Street concern. They expect CPI, headline, inflation to be 6.8 in December. What is that, 3 months away? What was it last reading? 8.3, I think? 8.1? No, 8.3. I don't know. Fall to 6.8? I'm not sure I see that, but maybe. They expect the CPI headline inflation December of 23 to be 3.6%. They do not see it possible to get to the Fed's target of 2% until 2024. What this new Wall Street expectation is the Fed's going to raise higher and stay longer. They expect the Fed to stay flat for 11 months. Folks, this is what I've been asking for, begging for. Go higher, go faster, get there, stay. There are no cuts coming in 2023. Those are Wall Street expectations. 3 out of 10, so 30% of Wall Street respondents said that they expect the Fed could go as high as 5%. Right? Again, the expectation is 4.25 or 4.26. This is the one. I talked about this earlier with Mark Zandi and layoffs. They are expecting unemployment in December of 23, so 16 months, to be 4.4%. Here is my unfortunate feeling about that number. One, if unemployment is only 4.4%, inflation is not close to being beat. I believe, unfortunately, for us to get inflation under control, the unemployment rate has to have a 5 on it. 5.2, 5.5, 5.7, something like that. We need to crush demand, unfortunately. Millions of people need to lose their job if you want to beat inflation quickly. If not, if we stay sub 5, inflation could be a problem through 23, through 24, and maybe into 25. These are the decisions, the trade-offs. The faster unemployment goes up, the lower inflation goes. It is almost, A and B. If unemployment stays low, inflation doesn't fall fast. That is the world that we find ourselves in. And then finally, what was his name? Scott Minerd is out basically telling the stock market, you are going to end in tears. The Fed is coming for assets. We have said that on this channel many, many times. I believe the Fed wants to walk up to the 1% and kick them in the proverbial nuts. The Fed is coming after the 10%, but we see the 1% on TV complaining and whining and begging for a Fed pivot. No, we have to help the 90%. The 90% haven't been treated well for 40 years. 40 years? Yeah, 40 years. It is their time. Unions, go get yours. Employees, go get yours. We need real wage inflation, not nominal, real wage inflation for years to come to get us out of what we have worked ourselves into. And then finally, folks, 158, or actually I should say 159. I need 159 more amazing individuals to hit the subscribe button. If you hit that subscribe button, 159 of you, we will be one step closer to 50,000, one step closer to an event in Vegas, one step closer to me spending at least 10 grand as a way to thank the community. So, like, subscribe, comment, interact with me, be a part of this channel. This channel is about doing the work. It is about understanding and doing great deals. It is always a good day to do a great deal. It is not easy, but it is doable. Like, subscribe, comment. Help us on our journey to 50,000, and we will see you in Vegas. Take care. Bye-bye.